Hey, Brian Mullins here. Today we're going to be talking about homeowners insurance. Whenever you buy a house, which is a great investment, you have to make sure you protect that asset because it could be your largest asset that you own. So you wouldn't want it to burn down or blow away, and then where'd all that money go that you spent on this huge asset? You have to make sure that you understand all the different aspects that go into insurance because the prices can range from super cheap to super expensive, but you got to find the one that fits best for what your needs are. So the most important thing to start with is what type of policy do you have? There are two main types, ACV and RCV. ACV is actual cash value. RCV is replacement cost value. So the difference really comes down to how much they're going to pay out whatever happens and they have to pay a claim out. So let's say you bought a house and you paid $200,000 for it. That's what it's worth. That's what the market says it's worth. So you bought it for $200,000. If the house burns down, if you're on ACV, they're going to pay you out $200,000 because that's your actual cash value. That's what that house is worth today because you just bought the house. But that house, to replace it, to build a brand new one of like kind at current building standards, would probably cost you $250,000 or $75,000. That extra value on top of that is that replacement cost. Where it really comes down is what's your goal? So if you're living in a house, this is an asset that you're living in and consuming. If it blows away, burns down, whatever, you want it to be at the same level that it was so you can continue consuming the asset. Where ACV comes in is, let's say you're an investor. I don't care. So I buy a property, it's an asset to me. It's just like buying a stock. So my goal on a stock is to make, 8, 10, 12% a year. Well, I'm doing the same thing on the house. So as long as my value of my asset is there, so let's say I buy the house for $200,000. If it blows away, I don't care to make $280,000. I'd rather save that money and get cheaper insurance. As long as I can get my investment back out of the house, that's all that matters to me because I'll turn around and go buy another $200,000 house and continue making the same amount of money that I was on this one. So it really comes down to what you want. If you want to save some money, you can go ACV. But if you're living in a house, I would always recommend doing replacement. It will end up saving you in the end. It will cost a little bit more, but your life will be much easier if something devastating happens to your home. Second thing to know is your deductible. So there's typically two types of deductible. There's going to be a flat deductible or percentage deductible, and sometimes I'll actually combine the two. So a flat deductible is exactly what it sounds like. You have a house and your deductible is $2,000. So if you have a insurance claim and they pay out $250,000, they're going to pay you $248,000 because your deductible is $2,000. That is a flat deductible. Some of them are going to be percentages. So, let's say your house is insured for, $300,000. You've got a 1% deductible. That means your deductible is going to be $3,000. Or 2%, $6,000. Now, where the hybrids come in is whenever you have both. And so I've seen this a lot, especially we're in Oklahoma, we have tornadoes. And so wind and hail will be a percentage, and then everything else will be just a flat deductible. It really just depends. But it's really important you understand this because this is going to affect your rate. And so, if you want a super cheap rate, you can call around and you're just shopping for the price. Somebody may jack your deductible up. You may get a 3% deductible. $300,000, that's $9,000. That's a lot of money. Let's say your house needs a new roof. That new roof is going to cost you $20,000. Your deductible is now half, almost. You really need to make sure you pay attention to what that deductible is and have that money set aside. Know what your deductible is going to be. Be prepared for something bad to happen. And so if it does happen, you just pull the money out because that's where we're already at. So the third thing is you need to know your coverage. So we're going to go through every different coverage item that you need to know. The first and most important and most expensive is your dwelling coverage. This dwelling coverage should be how much money it would cost to replace, if you're on replacement value, your home if something happened to it. So your replacement value is going to should be higher than what you paid for it, especially if you're buying a used home. You may be buying a 30, 40-year-old home. It's going to cost a lot more to build a new one. So you're going to make sure that you have that value in there. This is what it will cost if the house blows away for them to put a brand new house, very similar to yours, same size, in the same lot. It may seem a little high, but remember, let's say there's a natural disaster, like in my area, a tornado comes through, knocks out a bunch of houses in the whole area. The cost to build is probably going to go up because now everybody's ordering lumber and so labor is going to get short because you've got a whole bunch of houses being built all at once. So you're gonna wanna make sure that you have this number in place and make sure it's reasonable. Don't go crazy though, because if you go crazy, you're just paying for coverage that you don't need. Get a reasonable number. Your insurance agent should know what a reasonable number is, but make sure you're comparing these two when you're looking at different quotes. So kind of a subcategory for dwelling is your extended restoration cost. So your extended restoration cost is an addition to your policy that most homeowners have, and this is honestly a pretty good one. Most insurance companies will pay up to 25% extra if you're building back on the same lot and it ends up going over what your dwelling coverage. So let's say for easy math, you have a $200,000 house or $200,000 coverage, and you're building a new house and your cost overruns because who knows, pandemic and everything could happen, and now it's going to cost you $225,000. If your dwelling coverage is only $200,000, this extended restoration cost will go in and cover that extra cost. Now, one thing to note, most insurance companies won't pay this out unless it's actually an incurred cost. On the dwelling, you can usually get them to pay that out whether you plan on staying there or not. You can go buy another house with that money. But on the extended restoration cost, they're going to want to see actual cost receipts that's actually in excess of your dwelling coverage. But this could be really nice, especially if you plan on building back on the same lot. This is stellar. You can build back on the exact same lot and you have a little bit extra cushion to get a brand new house the way you want, as long as you don't go crazy. You can't add 1,000 square feet to your house. They'll catch on to that and they'll know. So the next item that we need to know when it comes to all of our different costs is our other structures. So what are other structures? Other structures are gonna be our fence, our shed, our greenhouse, whatever you have, she shed out in the backyard. This is the coverage that's gonna cover that. Your dwelling is gonna cover the house. Your other structures are gonna cover anything outside of the home. So this is a really important one to have. Most of the time if there's a major tornado, it's going to knock out the fence and the house. Usually the fence will go first because it's not as well built as the house. So you'll need to have that money to replace. This is a really important one to have. It's typically going to be about 10% or so of what your actual dwelling coverage is, which may be a little bit high, but like I said, if something bad happens, usually the costs are going to go up a little bit because you got labor and material shortages. Next is going to be your personal property, also called your contents of the house. So this number may seem astronomical, but it makes sense when you get down to it. So this is going to replace, if your house blows away, the dwelling and the extended restoration will cover replacing the home. The personal property or contents will cover everything inside the home. This is typically at 70% of the dwelling. Now that may seem like a lot. If you're at $200,000, you've got $140,000 in contents. You may say to yourself, oh, hell no, I do not have $140,000 in the house. You might. You actually might if you sit down and put the pen and paper to it, because you are putting everything at replacement. So what would it cost to replace everything? So I'll use, for example, this shirt. This is a Ralph Lauren polo. These are over $100 to buy. Did I pay $100 for it? No, I bought it on sale. It was like 35, 40 bucks. But if my house burned down tonight and I need to go buy a whole bunch of shirts, they're probably not on sale tomorrow. It's a random day, they're probably not on sale. So I'm gonna go have to pay $100 to replace the shirt. And it's the same thing with everything in your house. They're paying you full replacement value to replace it. So think about your TVs, your computers, think about your furniture, think about everything that you have, and you've accumulated over time. You don't realize how much stuff you have until you really start counting it. So this is really important. If you think it's astronomical, you can ask your agent to reduce it a little bit. It probably won't reduce your total cost a whole lot, but it may reduce it a little bit. But just keep in mind, if something does happen, you want to make sure you have enough money in here that you can easily replace all of your contents, because you're going to have enough stuff going on, and this is one you don't want to be worried about. Next, living expenses. Living expenses is a really important one because this is going to pay for you to live while your house is being rebuilt. This is typically quoted in months. So you're going to make sure that you have enough months in here. Mine, for example, is at 24 months. So I've got up to 2 years. The way it works is they're going to pay typically about 6 months while you try to figure out what you want to do. At that 6-month mark, you need to have a decision made. You should either be rebuilding a house or buying a new house. But they will pay for everything. So in that first 6 months, they will pay for your hotel the night that it happens, and then a couple days afterwards, while they're trying to get you situated, they'll get you into a rental. They will buy or pay for rental furniture for you so you have a bed to sleep in. You walk in, it's done. They will get everything ready for you, which is really nice. And it's one of those things it's so stressful when you lose your house that you don't want to have to think about that. And so this will really help alleviate that. And then they will pay for mine, for example, they would pay up to 24 months. So let's say my house burns down tonight, hopefully not, my house burns down tonight, and then I go into a rental for a couple days, maybe a hotel, get that figured out, and then I'm in a long-term rental for 6 months. In that 6 months, I have to decide, am I gonna rebuild my house? Am I gonna go buy another house? And so if I buy another house, then great, I buy the other house and that rental's done. Or if I'm gonna build a house, I will need to have construction started by the time that 6 months is up, and then they'll allow me to continue living there while construction is happening on the new house. So the final number we're gonna look at when we're looking at the coverage is gonna be our liability coverage. This is a really important one. It's not fun. You're never gonna see the money to you. This is to cover if something happens to somebody else. So let's say somebody comes over to your house, they slip, fall, break a hip, and they sue you. You need to find new friends if they do that. But if that happens, that's what that liability coverage is there for. This number is typically, around 300,000. It may go up and down a little bit, 250, somewhere in that ballpark. That's a decent number. It's really going to depend upon what your net worth is, because if you're worth more, people are going to try to sue you for more. What you're typically going to do is if your net worth is really high, you're not really going to change your homeowner's policy. You would buy what's called an umbrella liability policy. It's going to cover you for everything. So it'd be your cars and your house. All that's going to be covered under that. But for your actual homeowner's liability policy, you're going to want to have $250,000, $300,000 in there to make sure something happens. Typically, you're not going to see a judge award a ton of money on a liability claim whenever your insurance is $300,000. I mean, if someone were to file a claim against you for $700,000 or $1 million and you've got $300,000 in liability, you're now on the hook for $700,000. If you're like most Americans, you don't have $700,000 laying around, and what you should do is go file bankruptcy and make it go away. So there's really no point in doing that. The judges aren't out to get you. It's meant to be a reasonable claim. So that $300,000 should knock it out. You should be fine. Just keep in mind, if you are worth a lot and your net worth is high, have maybe an umbrella policy just to cover yourself. So let's talk about discounts that affect your rate. I've got a whole list of these, so we're gonna run through these. So it's important to know these because this is gonna affect when you're looking at a home, and this is gonna affect your day-to-day of how much you're actually spending on the policy. And if you can maybe do some magic, you might actually be able to get a cheaper rate. So newer the home, the cheaper the insurance is. Why is this? Well, if a new house hopefully is built up to better building standards, and it will be less likely to blow away, burn, whatever. Like new houses are required to have smoke detectors. Old houses from way back when weren't. So it would be less likely to burn if you wake up and call the fire department. Companion policy. So this is companion policy discount typically means auto and home. This is a really important one. So for example, whenever I bought my first house, I was 23 years old. Well, I couldn't really put my autos on my own name because I was 23 and I'm male, so your insurance is really high whenever you're a 23-year-old male in the United States for your auto. So it actually ended up lowering my rate on my house when I turned 25 because I could actually combine them onto one policy. Look at it like that. Make sure you're combining those policies. One thing that I always look at it as a total, right? So sometimes I get things in the mail for super cheap homeowners insurance. I'm like, that's an amazing rate. I'd love to save that money. I call them, get a quote. Well, they quote me on my car and it's way higher than what I'm paying. So as a combined, my rate may be about the same, or maybe even a little bit less than what they're saying. But make sure that you're looking at it as a whole and make sure you're taking advantage of those companion policy discounts. The next one's going to be alarm. If you have an alarm system in the house, make sure you let your insurance company know because that will actually discount your rates a little bit. These next two are a little bit weird, but it makes sense. One's going to be distance from the fire station. So how far away are the firefighters from getting to your house? Now you may need to get a little bit creative with this. So I'm actually in a very interesting predicament. So my house is right on the border of the city. There's another city that is way closer to me, and they have a fire station that is a whole lot closer than the actual city I live in. So I've had to go back and forth with my insurance company to count the other fire station because if something were to happen in my house, they have an agreement where they'll both go. So my actual response time is going to be less if my house is on fire than if they take just my city. So make sure you look at that, make sure you know where that is, and make sure they're actually counting the right one. The next one's going to be your distance from your fire hydrant. How far is a fire hydrant from your home? Typically, if you live in a recently, last 50 years development, you're gonna have a fire hydrant relatively close. Where this really affects is if you're out in the sticks. Let's say you have 10 acres of land, there's no fire hydrants out there. So that's actually gonna push your rates up a little bit. So make sure you know where those fire hydrants are, make sure you're taking advantage of those discounts, and make sure your insurance is. Age of the roof. So the roof is a really important one. It depends on the insurance company. My insurance doesn't care about the age of the roof. As long as the roof is in good shape, then it's insurable. Some insurance companies, they change the roof, at 7 years, 10 years, and they up the rate, or maybe they won't cover it for replacement costs, they'll only cover it for ACV. It really just depends. So make sure that you know what the age of your roof is, because that actually may end up being a discount. If you're buying a house, a used house, ask and make sure your insurance company knows. They can also send somebody out. Next is gonna be the type of roof. So your type of roof can actually affect your insurance. So if you have a roof, probably the best roof that you're gonna find on a residential home is gonna be a metal roof. Those are very hail resistant, so that should lower your rate. What I'm seeing is some insurance companies are offering discount on class 4 shingles. So essentially those are hail resistant shingles, are a little thicker than what the normal shingles are. Those are gonna give you a discount on some insurance carriers. So some roofers will tell you that you get a discount. Ask your insurance agent first, because they may not. Like mine doesn't give a discount, so I don't put class 4 on any of my roofs because I don't get a discount and it costs more money. So what's the point? Construction type. So what type of construction is your home? Most homes are gonna be, brick and frame. You're gonna need to know what type of construction it is. If your house is all frame, if it's all siding, there's no brick, typically it's gonna be a little bit higher. Think about it. If a hailstorm comes through, it's going to be more likely to destroy siding than it is to destroy a brick house. Next is going to be your credit. So your credit can actually affect your price of your insurance. Not all insurance carriers are doing this, but some are. So they'll pull your credit score. If you have a low credit score, they'll raise your rate. Your claim history is another really important one. So if you like to file claims just for the heck of it, then they will actually raise your rate. Sometimes they'll actually drop you if you file too many claims. So make sure that you're keeping an eye on that. So whenever I bought my first house, we had a hailstorm come through. I think it was the summer after I bought the house. It was a medium hailstorm. I went ahead and filed a claim and replaced the roof. The roof was okay. It would have lasted for quite a while longer. It wasn't really damaged. 2 years later, we had a real hailstorm come through with, big hail. It destroyed that roof. That roof was toast. There was no choice but to replace it. What I should have done is not filed the first claim. That second claim, I had to file a claim. The roof was completely toast. So keep that in mind. Yes, you're paying for it. Yes, you want to take advantage of it, but there's no reason to file for frivolous claims, because it's actually going to push up your rates if you do. All right, I got 2 more for you. So one is pay in advance. So if you are paying your insurance all up front, it'll actually be cheaper than if you're paying it over the year. If you're like most Americans, you're probably escrowing the money, which means it's going to your mortgage company and they're turning around and paying the insurance company. Those are all going to be paid in advance, because you're going to pay for it in advance when you buy the house, and then they'll escrow for the next 12 months, and then they will pay it again. So you're going to be paying in advance. If you own the house outright, try to pay in advance. Try to save a little bit of money. And lastly, loyalty. Some people say you should switch insurance companies often to get the best rates. The truth is, it really depends. You should check rates. I don't disagree. But there is loyalty discounts. And so the longer you're with an insurance company, it shows that you have loyalty, and they'll actually give you a little bit cheaper rate. So, your rate may be set at this, and then if your neighbor has the exact same house next to you, and they call the same agent, and everything else is the same, because they got their policy later, that will actually, be a higher rate. The other thing to remember is your policy actually carries over. So I still have the same policy that I had. My policy number and everything is still the same from my original house and the policy I got when I was 25 years old. So that policy is carried over. It's now 8 years old. And so I get a little bit of that loyalty discount because my primary residence has carried over all those years. So my last little tidbit about insurance is make sure you check the reviews. Make sure you check the companies that are out there and that you're looking at getting coverage from. Find somebody else who has them. Find somebody else who's filed a claim with them, and find out how good they are. Because you may find an insurance company that has amazing rates. You're like, I love this rate. This is so cheap. And maybe because they don't want to pay out rates. They do everything they can to avoid paying out claims. You don't want that. That's not fun. You've already gone through something that's horrible. If you completely lost your house, your whole life is turned upside down. You don't have a place to call home. this is not a time that you want to fight with them, that you want to get the lawyers involved and get the insurance commission involved. Don't want to do that. That's a nightmare. That is not worth anybody's time. So make sure that when it comes down to it, that you are checking out the insurance companies that are actually going to work with you and that you've known other people who've worked with them. And then you'll have a much easier time at the end of the day, and it'll be much less stressful on you. So I know I have covered a whole lot. Insurance is complicated. It's a pain in the neck, but it's one of those things you have to have. This is a very valuable asset. And for most people, this is the most valuable asset they will ever own. So make sure that you review everything. Make sure you go in with the knowledge. If you go in with this knowledge, you will be an informed consumer and you'll be able to get a much better rate and know the terminology, know what's going on, so it's not just all gibberish to you. So if you found this video helpful, make sure you take a second to like, subscribe, comment below, ask any questions. I'd be happy to help you. And make sure you check out all the other videos that we have coming out and we already have out. I'm Brian Mullins. Thank you and have a good day.